Every single dollar in your wallet was born in debt. That's not a metaphor, it's literal. The very moment a dollar enters existence, it owes someone money. But here's the paradox: if every dollar is created as debt, and every debt must be repaid with interest, where does the extra money come from? It doesn't. That missing money, the interest that no one created, must be borrowed into existence again, and again, and again. It's a system designed to never end, a financial treadmill where the economy must keep running faster just to stand still. This is not an accident. It's the architecture of modern money itself, the invisible design that makes you, your government, and every business perpetually indebted to the banking system. Today, we're going to uncover why every dollar is born owing interest, how this design came to dominate the world, who built it, and what it means for our future. The birth of money as debt, origins, the illusion of money. Most people think money is a thing: gold coins, paper notes, or digital balances. But money, in its modern form, is not wealth. It's a claim on wealth. Every time someone takes a loan, new money is created. When they repay it, that money disappears. The banking system doesn't lend out deposits, it creates deposits. This concept began centuries ago with a small, almost innocent innovation: fractional reserve banking. The goldsmith's secret. In 17th century England, goldsmiths stored gold for merchants and issued paper receipts, promises to pay gold on demand. Soon, they noticed something extraordinary: people rarely came to collect their gold. The receipts themselves started circulating as money. So the goldsmiths began issuing more receipts than gold they held. As long as everyone didn't demand their gold at once, no one noticed. That was the birth of money as debt, currency backed not by metal but by promises. The system institutionalized by the 18th century, this idea evolved into full-scale banking. Banks could create money simply by issuing loans. A farmer borrows £100. The bank doesn't hand over someone else's savings. It types a number into his account. That number becomes new money, circulating in the economy. But here's the catch. The farmer owes £100 plus interest, say, 105. Yet the bank only created 100. That extra £5? It doesn't exist. The only way to pay it back is for someone else to borrow more money. And so debt becomes permanent. The central bank revolution, the power to create nations and control them. By the 18th and 19th centuries, kings and governments realized that wars and empires were expensive. They needed money, lots of it, and quickly. Private bankers had the answer: we'll lend it to you. In 1694, the Bank of England was born, the world's first central bank. It would lend money to the crown backed by taxes on the people. Now, instead of minting gold coins, governments borrowed their own money into existence, at interest. Every pound the Bank of England created to fund wars like the War of Spanish Succession or Napoleon, as campaigns came with debt attached. The public never questioned it. After all, the system seemed to work. But quietly, power had shifted. The ability to create money, once a sovereign right, was now in private hands. America's repeated rebellions across the Atlantic, the American colonies saw the trap early. Benjamin Franklin once bragged that colonial scrip, money printed without debt, was the secret to their prosperity. When Britain banned it, forcing the colonies to borrow from the Bank of England, the colonies plunged into depression. Franklin later claimed this was the real cause of the American Revolution, but independence didn't solve the problem. From the First Bank of the United States, 1791, to the Second, 1816, and eventually the Federal Reserve in 1913, America kept recreating the same debt-based structure it once fought against. Each time, the story was the same. The government borrows, the banks create money out of thin air, and the people pay it back with interest. The breaking point: the Federal Reserve and the endless IOU, the deal that changed everything. In December 1913, on Jekyll Island, a group of powerful bankers and politicians secretly drafted a bill that would forever change the global economy. The Federal Reserve Act was sold as a way to stabilize the economy and prevent crises. In reality, it institutionalized the banking monopoly on money creation. The Federal Reserve doesn't print money, it creates it through debt. When the U.S. government needs cash, it issues bonds. The Fed buys those bonds, paying with money that didn't exist a moment earlier. That new money enters circulation, but it's born as debt. And those bonds accrue interest, meaning the government must tax citizens to pay it back, plus more interest. The cycle never ends. The dollar's disappearing anchor for decades, this system was balanced by gold. The dollar was as good as gold until 1971, when President Nixon ended the gold standard. Dollars no longer represented gold but promises. Now, the only thing backing your money is debt itself. Every dollar is created when someone, a person, business, or government, borrows it. When you pay back your loan, that money vanishes from the system. If everyone paid off their debts tomorrow, there would be no money left, only unpaid interest. That's why debt must constantly grow. Fallout: the cost of a debt-based world growth or collapse. No middle ground in this system. The economy can never stop growing because growth means more borrowing. When borrowing slows, the system crashes. That's why governments panic during recessions. They inject stimulus, lower interest rates, or print money to restart borrowing. But this only delays the inevitable. As economist Irving Fisher warned after the Great Depression, the more the debtors pay, the more they owe. The hidden tax of inflation. Because every dollar is created as debt. And because new money must constantly enter circulation to pay old interest, the money supply always expands. That expansion erodes the value of every dollar you own. It's why $1 in 1913 is worth about 3 cents today. Inflation isn't just bad luck, it's a structural feature of the system. It's how debt gets repaid collectively, through the silent theft of purchasing power. The wealth gap explosion, who benefits from this system? Banks. Because the interest you pay is their income, and because they receive new money first, before prices rise. By the time that new money trickles down to the average person, prices have already adjusted upward. This is called the Cantillon effect, named after economist Richard Cantillon, and it explains why asset owners, bankers, and corporations grow richer while wages stagnate. The debt-based system doesn't just create inequality. It requires it. Failed fixes and repeating patterns. The Great Depression in 1929. When loans couldn't be repaid, the money supply collapsed because debt repayments destroy money. Businesses failed, unemployment skyrocketed, and deflation gripped the world. The Federal Reserve, created to prevent such crises, stood by. Eventually, governments intervened with public works, debt forgiveness, and later, World War II spending. War, it turned out, was the fastest way to justify massive new borrowing. The boom-bust machine from 1945 to 2008, every economic cycle followed the same pattern. Expansion, fueled by easy credit. Debt saturation and slowdown. Crisis and bailout. Repeat. The 2008 financial crisis was no exception. When banks nearly collapsed under their own leverage, central banks printed trillions not by printing presses, but by typing digits into existence. Again, the debt monster was fed, not slain. The modern parallel. Digital dollars, same debt, the illusion of infinite money. Today, 97% of money exists only as digital entries in bank databases. Every time you swipe a credit card, take a mortgage, or the government runs a deficit, more debt is created. Even quantitative easing, the modern miracle cure, is just a fancier way of saying, we created money to buy our own debt. The result? Global debt now exceeds $315 trillion, more than 3 times the world's total economic output. That's not a statistic. It's a mathematical impossibility waiting for reality to catch up. Central bank digital currencies, CBDCs. The next stage, many nations are now exploring CBDCs, digital currencies issued directly by central banks. They promise efficiency, transparency, and security. But under the surface, they could mean absolute control. Imagine a world where every dollar you spend is traceable, programmable, and expirable. Still born from debt, but now monitored in real time. You wouldn't just owe interest, you'd owe compliance. The hidden mechanic, why it can't stop. Why can't we just stop creating debt-based money? Because in this architecture, money equals debt. Destroy the debt, and you destroy the money supply. To repay all debts with interest, the system must create more debt. It's a perpetual motion machine powered by promises, but bound by arithmetic. Even if we taxed the rich, forgave student loans, or printed debt-free money, it wouldn't fix the root flaw unless we fundamentally change how money itself is created. And that, historically, is where revolutions begin. Lessons from history, connecting patterns. Look back across centuries and you'll see the same script, played by different actors. Rome, debasing its silver denarius to fund endless wars. Medieval Europe, drowning in interest owed to crown lenders. Weimar Germany, printing money to escape impossible reparations. Modern America, borrowing trillions from its own future. Each believed their economy could outgrow its debts. Each was wrong. When debt exceeds the ability to produce real goods and services, collapse follows, whether through inflation, default, or war. The pattern is ancient, the mechanism invisible, and the victims are always the same. The working class who trade labor for money that evaporates in value. The hidden cost of stability, the irony? This system appears stable because instability is exported. Developing nations borrow in dollars they can't print, trapped in cycles of repayment and austerity. Meanwhile, major economies sustain the illusion of wealth through credit expansion, not production. Even your savings depend on perpetual borrowing. If people stopped taking loans, banks wouldn't just lose profits. They'd lose the ability to create money itself. Your deposits are someone else's debt. Their repayments delete your money. The 3 takeaways: 1. Money is not wealth, it's debt. Every dollar is a liability on someone's balance sheet. Real wealth is the goods, energy, and human effort that money only represents. 2. The system requires perpetual growth to survive. The debt-based system must always expand. That's why central banks fear recessions, why governments chase GDP, and why inflation is never accidental. 3. The future may be programmable. With the rise of digital currencies, the logic of debt-based money could evolve into direct behavioral control, a financial system where not just your balance, but your choices are monitored and priced. The warning: when money itself is debt, freedom becomes conditional. History shows that systems built on exponential debt eventually implode or reinvent themselves under crisis. The question isn't if, but when ours will. The next reset may not look like a crash, it might look like a solution. A new digital currency, a new kind of control, and a new promise. This time it's safe. But remember, every dollar, digital or paper, still begins the same way. Born owing interest. If you found this breakdown eye-opening, share it. Because understanding money isn't just about finance, it's about freedom. Subscribe for more deep dives into the hidden systems shaping our world, from the creation of money to the collapse of empires. And next time you hold a dollar, ask yourself, who does this really belong to?